With climate change at the front of many people's minds, more and more investors are getting excited about the prospects of investing in the electric vehicle industry. The rapid rise of Tesla led to a market frenzy after the COVID-19 lows, but demand for the sector has dropped alongside deteriorating market sentiment since the beginning of the year. But is it a good time to invest in the electric vehicle sector once again? Joining me today to answer that question is Anthony Sassine, Senior Investment Strategist at Kraneshares, which has recently launched a global electric vehicle and future mobility ETF. So welcome, Anthony. First of all, can you give us a bit of a description of the current state of the electrical vehicle industry, the opportunities and the long-term drivers you're seeing?
Absolutely. Thank you for having me. So electric vehicle and future mobility is one of the major themes that we're seeing now play out for the next probably 2 to 3 decades. We're seeing a lot of investor interest in that space. So what happened in 2020, we saw a major inflection point in EV sales, right? So it was the pandemic, but then EV sales just kind of took a sharp turn to the better in the third quarter and the fourth quarter of 2020, and since then it's been having very strong momentum, right? And that's really driven by multiple drivers here, including the government policy, right? Government has been a huge driver, major force behind this transformation. It's been going on since 2010, but now we're seeing that happen. Also innovation, because we're seeing innovation helping that sector, the car, become more affordable and more at par with the ICE vehicle or the internal combustion engine. Also, you feel that there's more awareness from the public, from the customers wanting to buy these cars for climate reasons, and also because they're cooler cars and faster cars at the same time. But for now, they're a little bit more expensive than the ICE. And also, we're starting to see more now suppliers and automakers, which has been hard for us to get them to divert their R&D to electric vehicles because it hurts their bottom line. We're seeing them do that now, and we're expecting close to 32 new models this year, which is a record, for investors to choose from. So there's a lot going on in that space. Like you said, we saw a downturn this year because of multiple reasons, including supply side disruptions. I think people are a little bit worried on how is that going to impact these companies, but I think there's a little bit of a misunderstanding here, which we can discuss later, because these companies have been getting ready for this for multiple years, right? And I think the impact on them is going to be minimal, especially that demand is not a problem on the EV side. You mentioned it's cyclical. That's mostly happened on the non-EV side, right? So, and then we're seeing higher rates kind of triggering a rotation from growth to value. So these type of things, we're seeing them happen now, impacting global portfolios. But if you look closely, EV names and EV sectors and the cars electric vehicle ETF, I think has held up better than other asset classes.
Okay, before we get into some of the finer details, can you tell us a bit more about the recent ETF you've launched and what makes it different from other funds out there?
Absolutely. So CARS, KRS with a K. It's CARS with a K, KRS ETF. So it's an ETF that seeks to provide investors with a comprehensive approach to the electric vehicle ecosystem. So not just the cars. Most people tend to abbreviate this the whole sector with Tesla and NIO, but actually Tesla sources more than 200,000 parts, 10,000 unique parts from outside vendors. So it's very important to catch the whole ecosystem. And that's the electric vehicle makers. That's the EV component, the guys who are doing the sensors, the hardware, the software, the infrastructure builders, whether EV charging or fuel cell hydrogen, the miners, the battery makers, the connectivity guys, right? And that sector keeps evolving, right? So soon we're probably going to see recycling companies enter the fray as well. So it's aimed to provide exposure to the whole ecosystem, and we do that with collaboration with BNF, Bloomberg New Energy Finance. Bloomberg New Energy Finance, they're based out of London, located globally in New York, China, and other countries. They have more than 300 to 400 analysts solely focused on this, and also Bloomberg Intelligence, right? So with their help, we kind of package that fund in a way that provides investors access to companies that are deriving most of the revenues from that space. We also run, very importantly, we run an ESG screen. So the fund is SFDR Article 8 approved. And and I know the fund by its own right is sustainable, but there are some of the mining companies that have issues. So we look closely at these companies with controversial issues, and we make sure we exclude them from that space. So if you look at it now, the fund will be capped at 4% for diversification purposes. Every maximum holding. Industry is capped at 40%, and the companies with low thematic are capped at 1%. So you get yourself a very nice fund here with a very balanced exposure. Most of it is electric vehicle, like 30%, 25% batteries, 19% raw materials, 6% hydrogen, 2% EV charging. And what's nice about this is some industries do well in some years where others don't. So you get that diversification, but over time the pie is growing, right? So yeah, I think it's a really good fund to take a look at. Also, the country exposure is more balanced towards the top 3 markets, China, EU, and US, versus when you look to other competitors, you see them more focused on US. They have some of these big tech, big semiconductor companies that have a small portion of their revenue related to electric vehicles, which in my opinion distort a little bit the factor exposure that you're trying to benefit from here.
Yeah. Now, it's really hard to talk about electric vehicles and automated driving without mentioning Tesla. I mean, it's been the recent craze. And I mean, there's other examples out there. We had Rivian Automotive. We saw what happened when they IPO'd last year after the frenzy we saw. How do you think the performance of Tesla and these kind of stocks that rose to fame in the last 2 years, how do they affect the perception of the electric vehicle industry?
No, absolutely. So you had a lot of confusion, I think, over the past 2 years about how can Tesla become a $1 trillion company, right? With less revenue than the usual $1 trillion companies. How can Rivian IPO at 80 billion and eclipse Ford and GM? This is a very legitimate question, right? So if you're looking at the short term, that's a whole different story because it's very hard to market time. It's very hard to see what's going to happen. Like we saw a war happen very unexpectedly, and we saw the implication of that on the whole industry. But if you think about this for the long term, right? You have to believe that these companies are going to grow in a big way, right? So if I have to boil down the investment opportunity, we're trying to replace 1.2 billion ICE cars with electric vehicles. Currently, we're at 20 million. And the leaders are Tesla and Rivian and these guys. So you can see over the next 20, 30 years, there's going to be a lot of demand for their cars, right? So if you ask me about valuation short term, I'm like, it's a tough question. If you ask me valuation long term, I have no doubt these companies are going to be much bigger than they are today, including Tesla. Let me just give you a back of the envelope calculation here. Tesla now revenue is 50 billion by selling 1 million cars. Elon Musk wants to sell 20 million cars. Let's slash that in half, 10 million. That takes the revenue from 50 billion to 500 billion, half a trillion, right? And now market cap is at 700 trillion. Is that still expensive in your mind, right? So when you look at it long term, the story is a little bit different.
Yeah, and what about the industry itself? Not so much electric vehicles, but in general, the automotive sector, it's a hard one to succeed in. We've seen over the history a lot of bankruptcies in the industry. It's a very cyclical industry, very capital and labor intensive, and they don't tend to perform very well during downturns. Now, there's a lot of concern in the market at the moment about potential recession approaching. We've seen that across the board. How do you think the industry is going to fare if we do end up seeing an economic downturn? How is that going to affect the fund? How is that going to affect the industry?
That's one of the big benefits, I say, of thematic investing, right? Because these are they have a higher certainty of growth over long term because of the strength of the demand, the strength of the momentum, right? So you have behind you governments wanting you to do this. You have consumers want to shift. So this year is a very, very excellent example, right? If you look at the automotive industry this year, it's down 15 to 20% year to date. You look at electric vehicle cars, in Q1, they were up 75%, right? So there's a huge difference between the two. We sell usually 80 million to 90 million cars a year, right? So in order to do like 5-10%, you have to sell 8 million cars. Last year, we sold 6.5 million. If you do 600,000 cars, that's 10%, right? It's very easy to do, but we're actually going to do 10.6 million this year. So that's like a 60 to 70% growth. So I think electric vehicles, because of the momentum, the strength of the demand and the low base, right? The growth is going to be very healthy for the next few years, and recession is not really going to matter as much.
So now we know that growth on the consumer side is strong. It's likely going to withstand economic recession. How about the supply side? Because you were talking earlier about the electric vehicle sector withstanding a little better than traditional automotive. Are you seeing any supply disruption risks for specifically for the electric vehicle sector?
Absolutely, there's definitely a risk in supply disruptions, but a lot less than the market thinks, right? So a lot of the decline you're seeing this year, it's like, oh, nickel's prices just went up to 100 and down. It was very volatile. Lithium is up 400% this, over the past year and a half. Some of the metals that are, actually produced in Russia, there's a big question about if these going to be on the market or not, right? So that's definitely things to worry about, for sure. But we have to take into consideration these companies have been getting ready for this for many years, right? If you look at the headlines, or you look at some of you're watching the news for these companies over the past 2-3 years, every few months you see that one of the companies bought a mine somewhere. Like Tesla just bought a nickel mine in Minnesota. They went as a technical partner, right? Not as a passive investor. Technical partner involved in the mining. They're now applying for a lithium mining patent, right? Trying to change the way it's done. BYD just bought 6 mines in Africa. They won a big 80,000 ton copper deal in Chile. Cattle also, which is the biggest battery maker in China, has been doing a lot of acquisitions in the lithium space and the metal space, and these guys have contracts ongoing, right? So we may see a little bit of volatility in terms of margins in the short term, right? But we're not going to see big major disruptions like people expect. However, the traditional automakers, it's a different story, because these guys were reluctant to make that move, and they weren't ready. They didn't get ready for the supply chain. Now they may find a little bit of difficulty, but based on what we're hearing, things should be fine for the next 3-4 years. And also, if they end up raising prices a little bit, which they did, the demand is so strong they can pass it to consumers.
Great. And just to finish off, how do you think the CARS ETF fits into an investor's global equity portfolio?
Absolutely. So now we're seeing a big shift in globally, especially in the US, institutional clients, in how they manage portfolio and the value proposition of institutional clients. First, it used to be, you do due diligence on the asset manager, on the active asset manager, you find a good portfolio manager, you give him the money, and then he will place you in the themes that are working, that he think they're best, that it's best value, right, for the level of risk. Now, because of the proliferation of thematic ETFs, now you have very targeted ETFs. Like at Kraneshares, we have a lot of different China ETFs and climate ETFs targeting every sector, every theme within those spaces. So now you can take those building blocks and build your own portfolio. CARS is, in my opinion, the poster child of thematic ETFs for multiple reasons. The way we built it, right, we made sure it has low overlap with MSCI ACWI, MSCI Europe, MSCI China, MSCI S&P 500 USA. So with that low overlap, what that gives you is differentiated alpha, right? So when you look at correlations, it has lower correlations than regular funds. And also, when you look at upside and downside capture, right, the thematic ETFs capture a lot more of the market upside and a lot less of the market downside. It's 150 to 74 on the S&P 500. So I believe this is a great addition in any global equity portfolio as one of the themes, or any ESG portfolio or impact portfolio, right? Low overlap, low correlation, higher, a potential for alpha, high upside, low down capture.
Well, thank you so much, Anthony, for joining me today. That was Anthony Sassine, Senior Investment Strategist at Kraneshares. You can invest in the Kraneshares Electric Vehicles and Future Mobility ESG Screened ETF on the IG Investments platform. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.